Thank you, Chairman Powell. Thank you for being here today and for your testimony. I'd like to start off, first of all, by completely echoing everything Congressman Barr said. A lot of us have talked about Basel III Endgame, and I think Congressman Barr kind of nailed the thought process. I do hope you'll kind of withdraw that and take the comments you've heard from here and from so many others about the hazards with the current approach. But I'd also like to address one of the other practices by the Federal Reserve, and it's the practice of paying interest on excess reserve balances held with the Fed accounts. It's my strong belief that rewarding banks with returns for taking no market risks actually harms our economy, and it discourages financial institutions from lending money into the economy. Instead, they park it at the Fed. This has little to no impact on very large corporations, but it can have a crippling impact on small and mid-market firms. And we especially saw this in the long recovery as Dodd-Frank was implemented in the Obama years, transition to the Trump years. We changed some of that mindset with a lot of other policies, but we saw a strong surging economy. So our countrymen pay a price for this market distortion by the Fed in two ways. First, they're unable to obtain loans at competitive rates because the money is sucked out of the market. Frankly, a lot of them don't even have access to lending except through bank capital. So it forces them into other forms of capital, equity capital, and others. Second, they ultimately pay higher rates whenever they have these alternative means of capital. And so today I've introduced a prohibition on the IOER Act, which would prohibit the Federal Reserve from paying interest on excess reserves. By eliminating IOER, we can begin to return our economy to the undistorted free market economy it's supposed to have. The alternative is you could simply raise requirements. We see some of those moral hazards when you do it across the board with approach like Basel. So what's your case for why you should keep paying interest on excess reserves?
Well, as you know, we don't see the downsides that you're talking about. You know, banks have a cost of funds and they have what they can earn, and that's what really matters is the spread.
And if they wanted to do it, they could simply buy treasuries on their own, and they could do that independently. I suppose they can independently keep it at the Fed, but they don't have to buy. They don't even have to put it on their own balance sheets in the same way. They've got immediate liquidity with Fed overnight account. So I don't see how that's different than what they could already do.
What I was going to say was, you know, banks can earn a much bigger spread by lending to corporates. So their incentive to lend is the same as it always was. This doesn't affect that. You know, really, it's they have a cost of funds and they have the ability to have reserves, but you know that's not going to. They're not earning a profit on that. So, or a big one. They can earn a much bigger profit by lending to small corporates.
Well, speaking of profit, I mean, the Federal Reserve isn't officially supposed to be a for-profit corporation, but you are supposed to pay for your operating costs off of positive cash flow. And right now, the Fed doesn't have positive cash flow. In fact, the Fed has negative cash flow. So it's not entirely unrelated that the Federal Reserve operated at a $114.3 billion loss in 2023 and currently is carrying a $133 billion loss on its balance sheet this year. So it's, you know, not the right approach, I think, to be paying essentially that much out in excess reserves to banks that are holding capital in the Fed when they could be deploying it into the market. So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, you know, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, for many years during the QE, large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, which to the Treasury Department. So you can't look at the loss without mentioning that we've been, you know, giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And you know, if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Thank you. And I think the last thing is I just encourage you to halt any effort to develop a central bank digital currency. It doesn't need designed, developed, and it certainly doesn't need established. I yield.